Hello?
Rachna, can you hear me?
Yes, sir, I can hear you.
Yes. Guest speaker has joined us. Abhishek sir has joined us.
Yes,
So
sir.
we may now begin.
Uh,
Father
okay,
Principal,
Father Principal.
I'm here.
shall we begin, Father?
Yeah, begin.
Yes. Rachna.
Thank you, sir. A warm good afternoon and welcome to webinar hosted by Department of Commerce, St. Xavier's College of Management and Technology, Patna, on the topic Investors' Awareness of Securities Market. Thank you all for taking your time to attend today's webinar. Before we begin the webinar, let me explain how you can interact with us during the webinar. This webinar is live on MS Team and YouTube both. If you face difficulty to join this webinar in MS Team, you may connect us through live YouTube by clicking on the link shared with you on the WhatsApp group. If you experience any technical issue during the webinar, please check your connectivity and try login again. If you have any question during the webinar, you can post your question in the chat box. The speaker's address will be followed by a question and answer session. Feedback link will be shared at the end of the session. Please fill in the information correctly to receive the e-certificate. Thank you. Let us officially begin our webinar. Robert Kiyosaki quoted on wealth that it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. With this word of Robert Kiyosaki, I, Rachna Thakkar, Assistant Professor, Department of Commerce, St. Xavier's College of Management and Technology, take this opportunity to extend a warm and a cordial welcome to our resource person, Mr. Kumar Abhishek, AGM Sebi Patna office, and Mr. Rohit Kumar Singh, Deputy Manager and Center Head Patna NSE. Our Rector, Father Joseph Thadvinal SJ, our Principal, Father Dr. T. Nishant SJ, our Vice Principal, Father Martin Porras SJ, members of management, eminent guests, my dear colleagues, all participants and my dear loving students, to an evening where we will have an fruitful interaction of knowledge. We are privileged to have all of you on this virtual platform. Your presence surely be a great pleasure to us. Prayer is nearest approach to the God. So to start our event, let us remember God and invoke His blessings upon us. May I now request Shivangi Kumari BCP3B to lead us all into prayer. Over to you, Shivangi.
Thank you, ma'am. The world stands in need of liberation, my Lord. It still have to feel your part. The blind and the deaf, the dumb and the maimed, all need to feel your healing touch. The world stands in need of liberation, my Lord. Still have to learn to love. There are those who have eyes but refuse to see their inhumanity to some. There are those who have ear but refuse to hear the cries of men in agony. The world stands in need of liberation, my Lord. It still have to feel your part. The blind and the deaf, the dumb and the maimed, all need to feel your healing touch. The world stands in need of liberation, my Lord. It still have to learn to love. There are those who have mouths but refuse to speak against injustice done to some. There are those who have hands but refuse to reach their mouths. world stands in need of liberation, my Lord. It still have to feel your part. The blind and the deaf, the dumb and the maimed all need to feel your healing touch. The world stands in need of liberation, my Lord. It still have to learn to love. It still have to learn to love.
Thank you, Shivangi, for melodious and a meaningful prayer. A smile is the universal welcome. With this word, I would like to request Father Dr. T. Nishant SJ, Principal, St. Xavier's College of Management and Technology, with his welcome address. Over to you, Father.
Okay, thank you, Rachana. Can you hear me?
Yes, Father, I can hear you.
Okay. So, respected resource persons, Mr. Kumar Abhishek, Assistant General Manager, Sebi, Patna, Mr. Rohit Kumar Singh, Deputy Manager and Center Head, National Security Exchange, Patna, respected observers, Father Joy James SJ, the Secretary of Jesuit Higher Education of Association of South Asia, JIASA, Father Dr. Tom Perumal SJ, the former Principal of St. Xavier's College of Education, Dr. Muniba Sami, former Coordinator of IQAC of our college, members of management, committed staff and lovable students, distinguished guests and participants. Namaste, good afternoon, salam to each one participating in this webinar. I'm extremely glad to welcome you all to another webinar. The topic of the webinar is very pertinent as we are still struggling to cope with the COVID-19 pandemic-induced financial challenges. Some of us say money can buy everything, but we know that it is not true. Money cannot buy peace. Money cannot buy joy and happiness. Money cannot buy sound sleep. No good health too. But money is a very precious commodity. We need to use it judiciously, and thus investing it wisely is very important for our well-being. An understanding of securities market could simply lead an investor to better financial decision making. This webinar focuses on a range of services provided by Sebi and NSE that help investors to stay abreast with the ever-changing market scenario, including the robust grievance handling mechanism. The information about online services provided by Sebi and NSE will also be the highlights of the webinar. Speakers of the webinar will speak on how to invest funds based on various factors such as inflation, types of investments, prevailing interest rates, purpose of investment, etc. I am sure it's going to be a very useful and beneficial session. I wish the eminent speakers all the best and you all participants an enjoyable and joyful learning session. With these words, I sign off. Jai Xavier, Jai Bharat, Khuda Hafiz. Over to Rachana.
Thank you, respected Father Principal, for your words of welcome. A small information that if you're not able to post your question in the MS Team chat box, you can even post your question in the WhatsApp group. Thank you. Peter Lynch quoted, "Know what you own and know why you own it." With this quote, I would like to introduce our topic of today's webinar, Investors' Awareness of Securities Market. I now request Mr. Ashok Kumar, Coordinator, Department of Commerce and convener of today's program, to address the participant. Over to you, Ashok sir.
Thank you, Rachna ma'am. I welcome all the invitees in this webinar, and especially our resource person, Mr. Kumar Abhishek from Sebi and Mr. Rohit Kumar Singh from National Stock Exchange, Patna. Securities market has become one of the most attractive investment avenues for investors nowadays. But a lot of investors fear to invest due to the volatility often seen in the market. Yet, the returns from the market attracts the investors. The insights from the experts in this webinar will help individuals plan their personal finance objectives. The discussions will address various questions on understanding the current market conditions, adoption of better strategy in these conditions, passive investment strategy, the common mistakes that investors make, among the other things. Now I invite our speaker for the day, Mr. Kumar Abhishek, to begin the session. Thank you. Abhishek, sir.
Yeah, good afternoon, all of you. I hope I'm audible. I request of you to please confirm.
Yes, you are audible, sir.
So actually, that was quite a warm welcome, and yeah, am I audible? My voice is clear.
Yes, sir, it's clear now.
Okay. So actually, that was quite a warm welcome. It is heartening to be addressing to a crowd like this. The welcome that we received from you all, that is really, really kind of experience to remember. I will start with the words which Father said. The respected Father said us that money is overvalued. Money cannot buy everything. That is very true. Money cannot buy happiness. That is the line with which I will start my presentation. Money cannot buy happiness, but money can buy us choices. And it is what we do with those choices that makes us either happy or sad. So basically, we should be well informed, we should be aware about the choices which we can make with our money and which choices are there for our happiness. So there, as we all know, broadly there are three kinds of choices we can make with the money. Everybody, all of us, have some kind of means of livelihood. I'm doing a job, I'm working in Sebi, you're working in your respective colleges, educational institutions. Somebody is doing business, there are different sources of income. People are earning livelihoods in different ways. Whatever we earn, there are basically three kinds of things, broadly, which we can do. We can either spend the money, we can save the money, and we can invest the money. So that is the way to use money. Spending is something which doesn't need to be taught. In this presentation, in this program, our focus is on the rest of the two. We would rather talk about savings and investment. Because spending, we all are very wise. Everybody does that. How we can save, how we can invest. That is critical, that is very important for life of all of us. If you want to be in a financially healthy condition, if you want your financial well-being, then you should be wise enough to do proper savings and proper investment. And with this presentation, we are trying our bit to be of little help, if possible, to all of you who are sparing your precious time to attend this program. I'll start with a PowerPoint presentation. I'm going to share it now without wasting much time. Please confirm if it is visible. Once it is, I will start. Ashok sir, can you please confirm whether you can see the Sebi building?
Yes, sir, it's visible.
It's visible. Okay. So that's the start of the presentation. Securities market and the common man. What a common man has to do with the securities market? What exactly is securities market? And how securities market can help us? That's what we will try to learn. The building which you are seeing on the slide, that is head office of securities market regulator, which is Sebi. So Sebi is a regulator. All of you are aware. I would give this knowledge of you about Sebi some perspective. First of all, I would like to discuss about financial market, financial sector. All of us have got some level of knowledge of economics. All of us know that economy is what economy is and what do we mean by the growth of the economy. In any economy, to ensure the consistent and sound growth of the economy, there is a need of well-developed financial sector, financial market. What do we mean by the financial market? We can compare the financial market with the normal market, then that will help our understanding. What happens in the normal market? In any market, there are different products being sold. Somebody is selling the product, somebody is buying the product. There is a exchange of money and product. Seller hands over the product to the buyer, buyer hands over the money to the seller. So there is circular flow of money and products, that is goods and services in an economy. And this is basic economic transaction. If this transaction happens more and more, then we say that the economy is growing. And what is financial market? Like I said, in economy, economic transactions should keep taking place. Goods and services should keep getting exchanged with money. So somebody who is producing and supplying the goods and services, a business enterprise, a company, or any entity who is producing goods and services, they always are short of funds because they are busy doing investments. They are investing in their capacity. They are installing new plants. They are buying machineries. They need inventories. They need raw materials. Like the producers always need fund. They have shortage of funds. But on the other hand, we, the common man, the common people, are more aptly called consumers. We, the consumers, have surplus of funds because whatever little we earn after spending, we are able to have some savings. We are able to save something. And we are able to save something. That something can be very beneficial for the economic growth. How? The savings which we have, that savings may reach to the business enterprises to serve as their capital, and then that become capital stock of the whole economy, and then investments, and then production, employment, growth, everything will take place. So financial market is a channel which makes sure that savings available with the consumers reaches to the business enterprises as their capital. So the investment which we do, it's not that simple. If we are making an investment because we want some financial benefit, investment from the point of view of a common man is committing funds for some time with an expectation that we will get some benefit. The benefit can be in terms of interest rate, interest, dividend, rent, value appreciation. It can be any kind of benefit. But that is the financial part of an investment. But the investment also has an economic meaning, which I told, which I earlier discussed, that our investment reaches the financial market, then it reaches to the producers as their capital and helps the production and growth in the economy. So in the financial market, there are four major constituents. The biggest of all is banking. We can understand with the example, we open a bank account, suppose FD, we deposit some money in the bank, then bank lends it out to the producers, to the businesses for investment in their productive production capacity. So banking is a followed by security, and securities market is where Sebi comes. Insurance and pension fund, these two are also part of financial market. All these four have separate regulators. The regulator is one who regulates. So the role of the regulator is make rules and regulations which have to be followed by the participants in the market. For the banking, RBI is the regulator. In securities market, if you have to participate, then the rules and regulations are made by Sebi. Sebi is the regulator here. Insurance IRDA, pension fund PFRDA. These are four major regulators in the financial market. Now I would like to talk about securities. In financial market, I discussed about four major constituents. We all know all of them. I think securities is least widely known as compared to others. So I would like to highlight briefly what do you mean by securities? What is the meaning of securities? I'll contrast the same with the bank account example. FD you have in a bank for a particular amount for a particular period, then that has certain characteristics. Suppose I have got an FD of 5 years. Generally, I cannot break it before 5 years. If I break, I lose some gains in interest. I may have to pay some penalty and all. So these kind of things are there. I cannot transfer my FD, which is in my name, in the name of my brother. Not normally possible. Insurance policies same go for them as well. They're not transferable. So securities are opposite to these. I mean, securities have very different characteristics. Let me tell you, anything which is a part of any product, anything which is sold in the financial market is a financial product, or we can also call financial instrument. Bank account, insurance products, pension fund schemes, securities, these all are financial instruments for investors, which investors use for investing. So all these financial instruments, out of all these, securities are very unique because they have unique traits. What are these? They are tradable. They have got very high liquidity. Tradable, I just discussed the example of transferability of bank account. This is not possible. Securities are easily transferable. I have got shares of some ABC company. I want to transfer it to anybody, XYZ. I can do it very easily. I can sell in the market for easy liquidity. Today I sell, in 2 days I'll get amount. I'll get money in my bank account. It is highly liquid. It's not like the FD, which I break and I may have to pay some, lose some benefits. So securities are very liquid, highly liquid, easily transferable, tradable financial instrument. Tradable because there is a ready market available where you can easily sell or easily buy. That is, you can trade the security. Securities are of different types. The most basic of them, the most common of them is shares. I hope all of you must have heard about the word share. Still, I'll try to briefly outline. Share means participation, a part. You're owning a part of something. That means you are a shareholder. If you're buying stock of a very big company, if you're buying a share, even a single share of a very big company, for example, SBI is the behemoth in the banking. So banking an SBI share, single SBI share. So for that share, you are the owner of the company. You got share. You are a shareholder of the company, and shareholder means you are an owner of the company. So each share of any company you buy, that makes you partial owner of the company. You have a claim, you have a right to claim on the profits of the company, which is called dividends. You have a right to participate in the meetings, general meetings of the company, do votings and all. So shares means if you buy a share, maybe even a single share or in large quantity, it doesn't matter. You are a partial owner of the company. Share gives you ownership. Bonds and debentures, on the other hand, are other kind of securities which makes you creditor of the company. Suppose आपने किसी कंपनी का you buy bonds of a particular company. The bond carries some interest rate. 7%, 8% का bond है. You will get a fixed annual interest rate. That is the coupon rate, 7%, 8%, whatever it is. So you have given a loan. If you are a bond holder, you have given a loan to the company which has issued the bond. If it is a government bond, then you have loan to the government, and you will get interest for buying that bond. So if you are a bond holder, debenture holder, bond and debenture are similar. They are debt instruments. If you are holding them, you will get a fixed return, interest. You get a fixed interest. Shares, you are owner of the company. If company is doing well, you will get profit. If company is losing, company is in loss, you may also have to share the loss. But bonds and debentures give fixed return. But return may not be as high or as lucrative as in shares. Then there are derivative products, which are complex products, which are constructed on shares or indexes or commodities. They are also securities. They are also tradable. They have got liquidity. They are highly risky. But they are highly risky. They have got potential to financially impact people in a very short amount of time, in a very severe way. Then there are mutual fund units. Mutual funds is a buzzword these days, and that is what we highlight in our programs often. These days, you are witnessing on your televisions, you are seeing the ads. Mutual funds sahi hai. Mutual funds sahi hai. These ads are very common these days, and these are the initiatives to educate the investors. These are the part of the initiatives to educate the investors about mutual funds. Because mutual funds are the most suitable securities for common man, for general investors. Then securities market is a part of broader financial market. We already discussed. Securities are tradable instruments. In securities market, there are certain indices also which tell us about the direction of the securities. Like I told about shares, there are numerous companies in our country which have issued shares to the public. The list is, 6,000, 7,000 companies are there which are publicly traded. So where can you buy the shares? there are two markets, two major markets for buying shares. These two are NSE, National Stock Exchange, and BSE, Bombay Stock Exchange. On these markets, on these exchanges, there are thousands of shares listed. You can buy shares of thousands of companies, or you can sell shares of thousands of companies on these exchanges. That is too huge a number. If you want to get a sense, if you want to get a sense of where the securities market is headed, then you need to have some kind of indicator, some kind of index. So there are two major indexes in the securities market. Like I told, there are two markets. Two markets here mean exchanges. That is NSE and BSE. For these two exchanges, there are two different indexes, two different indices. For NSE, the index is Nifty 50 and BSE Sensex 30. What are these indices and how they are made? So Nifty 50 is an index which has been constructed using the share prices of 50 companies. What are these 50 companies? As you all know, in any economy, there are different sectors like financial sector, telecom sector, insurance sector. Insurance is a part of financial sector, telecom sector, manufacturing sector, FMCG sector, infrastructure. There are different kind of sectors. So the major companies which has got good market share, which are kind of leaders in each sector, the major companies are selected, and their prices, how their prices are moving, that gives a sense how the securities market is moving. So based on the prices of 50 major companies across different sectors on National Stock Exchange, the Nifty 50 index has been constructed. BSE has considered 30 such companies across variety of sectors, 30 market leaders, and that has been used to construct Sensex 30. So when Nifty 50 or Sensex 30 is going up, short term, I'm not talking about the short term. In short term, there can be a lot of issues, a lot of factors, very minor factors which may affect their movement. But if you look at the long term, 5 years, 7 years, 10 years, you look at these kind of time frames, then you will see that these indexes, these indices move in tandem with the economy. If your economy is growing, obviously the companies will do good, their shares prices will increase and the indexes will increase. Indexes are barometers of the economy. They give us an idea how our economy is doing. So securities market plays a very important role, not only in availability of capital for the company, but also it lets the common investors know how the economy is doing for them. BSE Sensex, brief description about the index. BSE Sensex, Sensex 30, which I discussed on the previous slide. It's a free float market weighted stock market index. Basically, what we need to understand that it is representative of all the companies listed on the stock exchange, all the shares which have been issued by different companies. It gives us a sense how our economy is moving. It was first published in 1986, started with number 600, sorry, it was started with 100. And then now it is at what level, all of you know, it is close to 40,000. I think today it closed at more than 40,000. Nifty 50 is the Nifty 50 covers 13 sectors of the economy, and then there are different stocks, 50 stocks it considers of across the sectors. It started at 1000 in 1995. It started much later. Sensex was published in 1986. The base year was taken 1979, and hundreds was considered for 79. 86 it was not 100, it was more than that. 95 Nifty started 1000, and currently it is 12,000. So if you have invested at the time of starting of the index Nifty in 1995, suppose you have invested 1 rupee at that point of time, then you have got 12 rupees now. How many years it is? 25 years, your money has turned 12 times. It requires no brain to understand, to appreciate that it is quite a handsome return. And that you are getting by investing in the index, not in one company, one particular share, but in a product which represents a whole range of when big number of 50 shares, 50 different shares from different sectors. That reduces our risk too. Why securities are preferable as investments? Like we can discuss in bank accounts, we are getting 6.5% or 7% in an FD. The inflation rate we have got right now, inflation rate recently in the news you might have read, it's 7%. It's weekly data. I mean, inflation. If inflation rate is 7% and you're getting an interest rate less than that, means that you're not getting a real return. Return in the real sense is negative. But securities market have potential to give you a real return. Largely, the securities over the long term have consistently given return more than the inflation. In the short term, it may not be so, but if you talk about the long term, then it definitely beats the inflation and gives real return. Securities are tradable, hence ownership can be transferred, which is not possible with other financial products. It is generally highly liquid. Like I told, if you have got mutual fund units, you can sell today, you'll get money in 3-4 days. If you have got shares, sell today, you'll get in 2 days. So it is highly liquid. It provides wide varieties of investment opportunities for different level of risk. Like I discussed initially, when I was introducing the word securities to all of you, at that time, I said that shares are there, bonds and their debentures are there. They have got different risk levels for them. Each are associated with different risk levels. So securities market has a variety of securities which offer different risk levels and different return potentials to the investor. This kind of variety is not available anywhere for the investor. It offers scope for earning superior returns by enhancing one's learning. If you are making yourself more and more educated about the securities market, the program which we are doing here is pretty brief. You can at best consider it to be a very brief orientation. It's not giving some kind of knowledge. It's not giving you some kind of learning. If you talk about the learning, then you may have to devote some time. You may have to do some readings. There are good books. There is knowledge everywhere flowing. Sebi's website itself gives a lot of knowledge. Exchange websites can be explored to gain a lot of knowledge. If you get good knowledge of the securities market, then you may have the capacity, you may get superior returns. That is a possibility which is generally not available everywhere. And then securities market gives an opportunity to even a very small investors. The last point you can read, it gives even a small investor to be a part of the growing economy. The economy is growing, and even a very small investor who has got a very small amount to invest in, he also gets the benefit of the economic growth because his investments provide returns in line with the economic growth. Here what we are seeing are the three characteristics of investment. It's also called investment triangles. Investment triangle. However, the picture is of a circle. It's also called investment triangle. I'll explain that why. But before that, there is one more thing I will like to talk about. Generally, people ask when we make such programs, when we give such sessions, people ask, "Sir, I don't have money to invest. How can I invest?" When you are saying us to invest in securities market, invest in banking, invest here, invest there, so many options you are offering. That's good. But I do not have any money to invest. How can I get the money? That is the question. Which precedes the investment decision. Then we say that, sir, if I ask you what is savings, what will you say? Most of us say that, most of us will answer that, sir, savings is income minus expenditure. And this is a problem. Why we are not able to save? This is our approach, because when we get income, we feel that we have got the money for expenditure. We make expenditures happily without thinking twice why we are spending on this particular thing, why on this particular thing. We do not do any thinking. We just spend. And then at the end of the month, by God's grace, if we are able to save something, then we are happy that we have saved this much. This should not be our approach. That is the understanding which makes us say that I do not have any money to invest. So a simple exercise of budget making can be done for this. All of us. It applies to students as well. I mean, all of us, faculty or anybody, I mean, everybody who, it's for all of us. We should make our budgets, like we should list down for a whole month all the expenditures, the smallest of them, the biggest of them. For the whole month, we can note it down, and then at the end of the month, we can review them. And when we review, then we will get to know that there are good number of expenditures. Suppose there are 3-4 items which are unnecessary. Certain expenditures were required, but not the amount is higher. So here we will get a sense what is our essential expenditure which we need to incur and what expenditure could be dispensed with. And then if we get the essential expenditure, we know we can save some money. Suppose I am earning 100 rupees, my essential expenditure is 70 rupees. That means that I am able to save 30 rupees. I am saving or not, that is a different question, but I am able to save 30 rupees. Now, the definition of saving needs to be changed. The equation I discussed, saving is equal to income minus expenditure, that needs to be changed. Now, what should happen? Expenditure is equal to income minus saving. I get 100 rupees, I save 30 rupees in my other bank account. And then 70 rupees which is left in the first bank account, that 70 rupees I will use for the whole month to meet my expenditure. This will inculcate financial discipline in us. We will be financially disciplined and we will be able to maximize our savings. So once with the help of budget, we have maximized our savings, then we need to move on to the next thing, which is investment. Yeah, so sir, this small thing, I mean, am I clearly audible?
You're audible.
Am I audible? Please confirm.
Sir, you are audible.
Okay. It's a very small issue. I mean, the person from NSE is trying to join. Probably he has joined. You need to make him presenter.
Okay.
Gaurav is there.
Gaurav.
Yeah.
Okay, sir.
Can you see them? Gaurav Motwani, Gaurav Kumar, Gaurav is there. I am getting a message.
Yes, Gaurav Mutwani, this is here.
Gaurav Mutwani is there, na? So please,
Yeah, I am
make
there.
him present. Yeah, he will present on the NSE, on NSE's behalf.
Right.
Okay, sir, then I am continuing to try.
You continue, please. I'll make him present.
Yeah, I will hand over to the Gaurav. Abhi, there are 2 slides I will discuss. So let's get back. Investment triangle. When you are going to make an investment, what you need to consider? You need to consider 3 things: returns, safety, and liquidity. Returns, you are going to invest. Obviously, you want some benefits. Benefits means returns. It can be interest, it can be price appreciation, it can be dividends, it can be rentals, it can be anything. Returns should be good enough, generally more than the inflation. Then safety. Safety is another consideration. If somebody is offering us very skyrocketing return, then that person is going to sky with our money. All fly-by-night operators. In the newspapers, you might have read. It was more common. I mean, few years back. Now these things have slightly. These things have reduced. I mean, much reduced rather, I would say. But fly-by-night operators offered very lucrative schemes to the people. We will double your money in 1 year, in 6 months, in 2 years, 3 years. As lucrative as it could get. The skyrocketing returns, but your money would never return. It will go to the sky. So safety is another issue which you should consider. Like I discussed, you should invest in the regulated market. Banking, I mean, if you're going to a bank or to open a bank deposit, you check that the bank has got RBI license. The bank is registered, licensed with RBI. Nobody can do the banking business like this. So, if it is regulated by RBI, if it has got a banking license with RBI, then you consider it to be a safe option, safe investment place. So that should be checked. If you are getting into securities market, then everybody you deal with, please check they are registered with Sebi, be it stockbrokers, be it DC, or any other securities market agents or intermediaries. So regulated, if it is regulated, you have some assurance of it. If somebody is offering very high return, then it is probably fraudulent. It is probably going to be a fraud, and don't fall into this trap. Return is required, but it should be reasonable. You might have, I mean, all of you might have heard on FM, there is very frequent RBI announcement which says that nobody can give you an assured return of 12.5% a year. Nobody can give you assured return of 12.5%, more than 12.5% in a year. Here I would like to tell one more thing. Rule of 72. Some of you might be knowing, many of you might not be knowing. Rule of 72 is a thumb rule which we used to find out in how many years my investment will double. Suppose I am investing 1 lakh rupees today, in how many years it will become 2 lakh rupees? I am interested in knowing that. If I am doing a bank FD at 6% interest rate, then in how many years that will double? So we can use the rule of 72 here. What is it? Just divide 72 by the interest rate. What you will get, that is the number of years required for doubling the money. So 72 divided by 6 gives us 12. So at 6% interest rate, our investment will double in 12 years. And suppose the interest rate is 8%, our investment will double in 9 years. 72 divided by 8. And if our investment is doubling in 4 years, somebody is promising us that your investment will double in 4 years, then that means that the interest rate which they are offering is 72 divided by 4, that is 18%. And 18%, as you all know, nobody can guarantee a return of 18%. So that means that the person, the entity, the company, whoever it is going to take your money and just fly away. It's not safe. So we should take care of these small things. Safety is very critical, very crucial. We want interest, we want value appreciation, but rather we should make sure that we do not use our principal itself. Liquidity is another very important factor. Like I discussed, securities market securities and securities market, all of them are very liquid. There are other products also, like you have savings account, that is very liquid, current account, recurring, bank deposits are pretty liquid. So, but if you have invested all of your fund, whatever you have, your corpus, everything in real estate, so that is not very liquid. I am not saying that you should not invest in the real estate. Everyone should invest. It gives good return even over long term. But liquidity is not there. And if anybody has urgent requirement of funds, then nobody can depend on that kind of investment. Liquidity should be our concern. Moving on. Risk reward matrix. When we discuss about safety, then we briefly discuss that if somebody is promising very high return, then that is too risky and too good to believe. It is fraudulent. We should not fall into that. But in securities market, like I said earlier also, there are a variety of securities which have different risk return characteristics. Some are low risk. Different kind of things are there. In financial market, I would say this example is the slide which you are seeing on your screen. This is for products in the financial market, and they have got different kind of risk and reward scenarios. If risk is low, return is low. So we can see the bottom left. On the left side, the bottom one, bank deposit, post savings account, post office savings, PPF, debt-oriented mutual funds. These are rather low risk, low reward, low return products, financial products. Then there are some products which are high risk, high reward. Derivatives are there, equity and equity-oriented products, shares, mutual funds which are invested only in equities. They are high risk, high reward. In high also there is a degree. Derivatives are extremely highly risky. It's very high risk. Shares of blue chip large cap companies are moderately risky. Shares of small companies or relatively new companies, they may be very high risk. Maybe carrying very high risk. So there is a degree in high risk also. However, broadly we categorize shares and mutual funds which are related to shares and derivative products are high risk products. So high risk and high reward. So if you are taking low risk, what you will get low reward, like in bank account, FD and all. If you are taking high risk, that doesn't mean that you will get high reward. This risk reward matrix doesn't tell us that if you are taking high risk, you will get high reward. That is not the correct interpretation. If you are taking high risk, you may get high reward. There is some potential of getting high reward, but there is a possibility that we may lose our investments as well. If it doesn't become zero, it gets significantly reduced. So, if you are taking high risk, that means that there is some potential that you may get good return, high return, but there is more probability, more chances that your return will not be that high, it will be low. Then there are low risk and high return. Low risk and high return. So there are no such products where risk is also low, risk is low and return is high. If somebody is saying that there is low risk and return is high, then that is the scheme which you should be aware of. You should be, you should keep yourself away from those kind of schemes. That is not possible. Moving on, this is again another kind of representation of same. You can see low risk products are cash and savings bank account, then there are bonds and fixed deposits which carry a fixed interest rate. If you are investing 1 lakh rupees, it's for 7% bond, then you are getting 7,000 each year, 7% interest. So this is fixed return. Then there are some mutual funds which are investing in these kind of products, bonds and all. So these mutual funds are also relatively low risk products. Why do we invest in securities market? Securities market investment has different benefits. Broadly categorized as 4: capital growth and returns. We have talked about diversification, because there are a variety of securities, you get the benefit of diversification. There are tax benefits as well. This is an important consideration for us while making investments. Traditionally, it has been. Then returns. Capital growth and return. It is same thing which we have discussed. In investment should beat the inflation. You should make sure that you make an investment which is at least higher than the inflation, so that your investment doesn't suffer. The value of money, with inflation, the value of money decreases with time, but make sure that your investment grows to keep pace with your investment. The return from investment beats inflation. That should be our approach. That means capital growth, actual capital growth in real sense. Diversification is a very important investment concept. Don't put all of your eggs in one basket, or don't put all your apples in one basket. If one of the apple gets rotten, it will make all the apples rotten. So if you keep many boxes, many baskets, and distribute the apples, then even if one basket is wasted, others will serve you, others will be useful. So diversification is the same concept in investment. It says that do not invest everything in one place, at one place. Do not invest everything in shares or everything in mutual funds. Have some amount in bank account also, some amount in insurance also, some in mutual funds, some in securities, shares. In mutual funds also, there are a variety of mutual funds. You can diversify there also. So there are wide diversification facilities, diversification possibilities in the securities market, which we should take benefit of. Asset allocation is nothing but the variant of diversification. Invest across the asset classes. अलग-अलग जगह invest कीजिए. Have some investment in real estate also. Some investment, you may have a very small investment, maybe 5% in gold also. Then large portion of investment, depending on the age or the financial condition of the person, may be decided in the equity or in the debt. Equity means shares, debt means bonded debentures, which we discussed earlier. So if somebody is very young, 25 years old, a person who joined the job, secured job, pretty secured job, getting good salary, that person can have a good exposure. Higher proportion of investment can be made to the shares, to the equity. It can be directly in shares, or it can be in equity-related, shares-related mutual funds. Then somebody who is 55 years old, retiring in 5 years, so that person, I think all of his investments would be in low-risk investments, maybe in FD, maybe in mutual funds which are related to debt, fixed income mutual funds. So it's depending from the person to person. It depends from person to person. A person may take high risk depending on his financial condition, what assets he has, what liabilities he has, then what is age, everything is required to be considered. So accordingly, when we are doing analysis for ourselves, we have to see how much assets we have, how much income we have, what liabilities or responsibilities we carry. So accordingly, we have to know how much risk we can take. At what age we are, I mean, what is our age? How many more years I have to earn? Everything has to be considered. Then we have to understand our risk position and accordingly decide which are the investment options I can choose, and then I have to diversify my investment into investment options. That should be our approach. It should be across the asset classes. That means that put some amount in bank, put some amount in shares, put some amount in mutual funds. Now within the asset classes means if you are investing in shares, invest some in ABC Limited, some in DEF Limited, some in XYZ Limited, not in single company. If you are investing in mutual funds, then invest in 2-3 types of mutual funds, not only single kind of mutual fund. However, even if you are investing in a single mutual fund, then also you are getting the benefit of diversification. The reason is mutual fund is something. Mutual fund is a regulated investment scheme which cannot concentrate the investments in a particular company beyond the level. It has to be diversified. Even if you are investing in a single scheme of mutual fund, then also it is diversified. And that is the duty of the fund manager of the mutual fund. Mutual fund we will discuss that in detail in the presentation. It will be taken up by Gaurav. At this slide, I end my presentation. Thank you for the wonderful and patient listening. The wonderful cooperation is something which I highly appreciate. I request Gaurav to take on from here and start the presentation and discuss about securities, about do's and don'ts of investments in securities market, and about other things which are part of the presentation.
Yeah, thank you so much. Yeah, I hope I am audible. Can somebody give me a confirmation and whether my
Yes,
PPT is
Gaurav
visible?
sir, you're audible.
Yeah, and the presentation is visible?
Yes, sir, it's visible.
Yeah. So firstly, good evening, Father. Good evening, all the St. Xavier's faculty members, the participants, students. Good evening from Sebi, Mr. Abhishek. I thank you for giving me this opportunity. What has happened is there's a last moment medical emergency that Rohit had to take care of. So I am just pitching in on his behalf. I'll just introduce myself and start the presentation. I am Gaurav Motwani, a senior manager with National Stock Exchange. I am taking care of the investor services cell and arbitration for eastern side of India. So I'm pitching in for his behalf. Okay. So starting off this particular presentation, it was a very good background that all of y'all, the students, had received from the father and the guest speakers as well, including Abhishek from Sebi. So that was a great background for us to start from. Now, see, one thing that I would like to inform all the students is that please understand one thing, that please do not think that, moment we're talking about securities market, that means only finance students or commerce background students need to listen to this. Please understand that every single person earns money. And moment you earn money, if you put it inside your cupboard, that means you're putting your money to sleep and you are working hard. Rather, what we should all be doing is making the money work for us harder so that we can retire earlier. Pay very close attention to what I am saying. You need to make your money work hard for you so that you can work harder and retire faster. Now, what we instead do is we rather work hard day in and day out, day and night, and make our money sleep. Why do we say so? Now the kind of returns that are there you get while you invest your money. Suppose you invested, like Abhishek had explained, the hierarchy. If you're putting your money in a savings bank account, Today you get a return of 3.5%. Tomorrow you put it in a fixed deposit, it raises from 3.5 to probably 6.5. Moment you put it in bonds, it touches 7%. So you might say that, when there are so many instruments, why do I need to take that risk and invest in securities market? It's a complicated market. Why do I need to get into it? A lot of people would be very interested. A lot of people will not care about it. But we need to understand one thing. The way we measure our returns is after we subtract inflation. That's what the economics calls it as real returns. So if you see in today's market, the inflation is pretty high. We are a growing economy. The inflation will continue to be high. In the long-term perspective, we are a high-growing economy, fast-growing economy with high inflation. So inflation numbers will stay high. And if we keep investing only in deposits, small like fixed deposits, the real return that you get eventually is nothing. So tomorrow, if you want to, there are a lot of things people need money for, right? There's a wedding in the family, there's medical emergency, there's higher education, there is needs and wants. So there are a lot of things, right? So how do I achieve all of this thing? If you keep working hard for everything and make your money sleep, you will not achieve anything. So you work hard and you make your money work hard for you, right? In securities market, yes, there is risk. But please let me give you a small example of how to understand risk. There's nothing to get scared of from what is risk. Now I'm taking the best, easiest way for a person to start investing in securities market is through mutual funds, which we will cover. Moment we understand mutual funds, then you can move into securities market. The other forms of securities market, like equity and debt and the derivative instruments. Now, if you start a small SIP, which is SIP means it's like a systematic investment plan. A systematic investment plan means it's like an RD. How in a bank you have a recurring deposit, the same way is SIP in mutual funds. So for month on month, a specific amount that you have already declared will be deducted from your savings account and will be invested into the mutual funds. Today, the mutual funds start with as low as 500 rupees. So if I say tomorrow, there's a lot of risk in securities market, the value of the portfolio is fallen down by 20%, big terms. But if you put it in actual mathematical numbers, if I have 500 rupees with me, if I'm putting it, and I say the portfolio value is down by 20%, that means how much have I lost out of 500? 520% is what? 100 rupees? Today is the value for any 100 rupees. Today you go a party, celebrate birthday. How much do you spend? 5,000, 6,000 bucks at least, right? And here we have a chance wherein we can change our entire life. We can achieve our dreams by just understanding and taking the small risk. So what we do is what Abhishek has been explaining to all of you all this while was a lot of methodology through which you can diversify the portfolio and reduce the risk. So don't get scared by understanding what the risk is. You can start with small investment of 500 rupees. So start with small 500 rupees and see whether you understand the markets or not. So why do you start with mutual funds? Because you don't have the expertise to start. So you give it to an expert who is a mutual fund manager who will manage it on your behalf. See how they are managing money. You understand this is how money gets invested. This is how you get returns. So once you're equipped with all the tools necessary to understand, then you can get into investing in shares and warrants and mutual funds and etc. That's the way to, right? So assuming now that we are all pretty much on the similar background where we understood what, see, I'm not going to explain this entire securities market to you all. I would encourage all the students that are there to just note them down. You can just Google it. But the style in which I will present it to you all, I would request all of you all, if there's a finance club or, if there's a financial students are there, finance background, you can probably start explaining these products to yourself or your peers in the way that I would do for the first part called shares. So I will explain shares to you in a slightly different, so you can understand and then probably explain to your peers and or self-learn the other products, right? So I'm just this slide has been on for quite some time, so I hopefully people have noted down, what these products are. So when you say I'm investing in securities market, please understand securities market is not one instrument. It is this is only a sample of all the instruments that are available. Like for example, if I say derivatives, there are so many products under derivatives. So basically there are hundreds of products that are available. It will depend on your risk taking appetite that will you will need to invest. So as I discussed, I'm taking with the first one with shares. Okay. Now I am explaining what a share is. You would have read it in your book what a share is, but this is how I would explain what a share is. So here is a company who wants to invest, probably has a business idea or an expansion plan. Now, all the money that it could take from its peers, all the money it could take from bank have been exhausted. So now it has an expansion plan where it needs more money, and the bank or exhausted, the bank is not able to fund more. So who has more money? The public, we, us. This is what Abhishek was trying to explain to all of you all, that money is with us. So the company comes to us, and the company, so the investors will pay money to the company, and the company in return will give shares. So this is what. So once you receive the share, you are the equal owner of the proportionate amount of share that you have received. All your rights are equal to the owner. So if the company does well, then the company will earn profits. They can distribute that in terms of dividend, or they can distribute that, or they can hold back certain funds for further expansion plans. So if it does well, it will distribute money to you all. The other benefit, if it does well, the share price will increase. So how does the share price increase? If you realize whatever prices that you're seeing in the market, the face value of the shares is far lesser. It's 1 rupee or 2 rupees or 100 rupees share, which has been traded for thousands of rupees. So the face value is the value of the particular share, the book value, and depending on demand and supply, the value of the price increases from the 1 rupees face value to the market value. Okay. This is more educative in nature. So we know what are types of market. There's a primary market and a secondary market. The primary market is a market where the first time when the shares are issued by the company to the public at large. How that happens is, first the company, they send an offer document to Sebi, which is the Securities and Exchange Board of India, and Abhishek is the one who's representing Sebi. So they give the offer document to the Sebi, and then Sebi passes certain observations. So what is the offer document? It will basically provide details such as, what is the background of the company, who are the directors, why do they want the money, what is the existing background, what are the risks involved in the businesses. So you have a specific background and you understand what you're getting into, what you're investing in. So they will issue an IPO, which is an initial public offering. So what that happens is the public first has to give the application form and money to the syndicate member, and then the syndicate member will post. All this happens through the exchange platform. So what happens is the syndicate member on your behalf will punch the order on the exchange, and then we receive the order. And once it is closed, then the shares are allotted by the company to all the shareholders. There's a formula through, and once they give all the allotment is done. The allotment is done by the registrar and transfer agent. So what happens is, initially the money that you used to pay, they used to be in the form of a check. So you have to give the check to the syndicate member. So now what happens is there's no check system anymore. There's something called as ASBA, which is account submitted by a blocked amount, which is ASBA. So what happens with ASBA facility is the fund in your account it continues to stay in your account, but there's a lock created on it. So you will not be able to withdraw that particular funds. And if the allotment is done to you, then the shares will come to you and the money will get debited. If the shares are not allotted for any reason, the lock will get released. So what happens is the benefit is here that the money does not move out of your account. So in case of non-allotment, you don't have to run around or wait for the money. Second advantage is that you continue to get interest on that fund that is kept in your savings account. So that's the benefit. So using that ASBA facility, now ASBA is mandatory anyway. So through ASBA, you will be able to apply. So this is how the primary market works. And we know secondary market. So once the company allots the shares to the shareholder will, eventually someday need to exit from the market and take his money back. So how will he do it? So you can see the diagram below. That is how the secondary market works. The investors will punch in their orders, or will tell the brokers through which they open an account. They will tell it to the broker to place an order on their behalf on the exchange. So the exchange receives the order. On the left hand side, you see the farmer. So basically what that they're trying to show you is that these days You don't have to go to the broker's office to go, start trading. So anybody who's interested in trading, so you will first need to note down that you need two types of accounts. One is a trading account and second is a demat account. Trading account is an account through which you will execute all the trades, and demat account is an account where you will place the shares. Just like a bank account, the way you keep money in your bank account, demat account is an account through which you will keep all the shares that you have purchased, right? So basically what we're trying to show is the farmer here is supposed to be the end seller of the particular share. So there's an agent. So today you can online open all these accounts and place an order with your broker. The broker will in turn place it to the exchange. So that's how the selling will happen. Once you procure the shares from the company, then you will be able to sell it. Okay. Now, don't get into the complicacy of the chart. Basically, what it tries to explain to you is when you enter into the securities market, no matter whether it's in mutual fund or it is in shares, always ensure that you are putting in money that you do not require for a long time to come. For the next 5 years, you do not require any money. Ensure that you invest only that amount of money. Why? So investment in securities market must be only long term. So long term investment only, right? No short term. Only once you understand the market, people who are an expert and willing to take that risk, for them it's okay. Else you always stay invested. Why? Now see, if you see, it says stay invested. So this is a chart of Nifty. So on the left hand side, if you see 1 day, you see 1 day on the left hand side on top that is slightly highlighted. So basically, it's all it's trying to tell you is that on a particular day, you saw the share, the movement is going down. So if you are putting in money for short term, say I have only money for a day, and if you're invested at 12,000 rupees, 12,000 plus. So when you take it out, what will happen? You will be able to take it out for less than 11,650, right? But at the same point in time, the securities market or the share market does not increase in a straight line. There are always ups and downs. You have to ride that up and down. So one of the tools through which for you to ride that up and down is an SIP, and second is staying invested for a long time. So this is a chart for 1 day, right? Had I not sold it, if I have the patience and I had not sold at the end of the day, now you can see at 11,650. If I had patience, then you see this is how the market increases. Now I have changed my chart from 1 day to maximum, right? So you see the chart. The movement of shares will never be in one direction only on top. It will have ups, it will have downs. But if you take an interval of 5 years period, so for every 5-year period, if you would have noticed, you will always end up in getting some gains. The gains are never constant. If you take an average, it's roughly close to 15 to 18%. Of late, the interest rates have come down, so you can say 12 to 15% is something that you can expect on a 5-year horizon, right? Same, one of the very interesting products for India is gold. Unlike the rest of the world, we Indians love gold. So apart from the last 5-year period where gold was on a lull period, gold has never given negative returns. So for you to invest gold is not by buying physical gold. That's not called investment in gold. If you want to buy gold, there is something product called as gold ETF. It's called paper gold. That's the product you need to invest if you're interested to invest in gold. So we've discussed that you need to open a trading account and a demat account, and that's how the dynamics of securities market work. For all the people who are new and starting off afresh, my personal request would be to start off with a mutual fund. Why? Because you have a mutual fund manager who will diversify, who will manage the fund on your behalf. The risk is very less compared to others because your fund is the mutual fund that you invest in is a diversified mutual fund. All you have to do is mutual fund has the risk barometer. It's a low risk, medium risk, and high risk. So every single mutual fund that the mutual fund agency sells, there's in terms of medium risk, low risk, and high risk. You only need to select what kind of risk you can take. As I told you, high risk. High risk means what? 20%. 20% at 500 rupees is what? 100 rupees. I think that kind of risk we can take if I'm able to understand the market and achieve my dreams. Personally, if you talk to me, I have invested, 2 or 3 years back, I started some particular funds. They are still in negative. But the thing is, you have to, if I stay invested for a long time, I believe if India will do well, moment India does well, the country will do well, the country will do well, the index will do well. So I have invested in for 10 years, I'm not going to look at those funds. So that's the way you need to have a, thought that I'm not going to look at these funds until unless a fund is performing very badly, or if there are some issues with the fund, only then it's a good idea to move away from that fund. Else, stay invested for the next 10 years. I'm sure that definitely the returns are there, right? So what is a mutual fund? So basically, if you have a mutual fund, it's a, all the investors who pool in all the money and give it to a mutual fund manager who manages the fund on your behalf and invests in securities. Now, understand one thing, there are multiple types of mutual fund. For a low risk mutual fund, the investment will be in, government bonds, state bonds, corporate bonds, maybe even some fixed deposits. There are other types of balanced mutual funds where, half the money will be invested in bonds, half the money will be invested in shares. And there are other forms where entire money will be invested in securities markets. Rather not securities market, but in equities and derivatives as well, right? So it will depend what kind of risk you have agreed to take, right? And then it generates a particular return. Whatever returns are there, we all know it by the name of NAV. NAV is a net asset value. So what is the NAV that you have invested in, and today what is the NAV? That's how you compute your returns. So I think we've covered enough of why of mutual funds. So you see the evolution of mutual fund industry. This mutual fund Sahi hai, the one that Abhishek had said, as kicked off in the market exponentially very well. It's an amazing way to enter into the markets. And please understand, there is no correct time to enter the market. There is no time to enter the correct time to enter the market, right? So every time is a good time, and start your SIPs as fast as possible. So this is a type of, there are multiple types of mutual fund. As I told you, just take a note of this. I'm not going to cover this. I think we are running short of time. So ensure one thing that, you understand what kind of product you're getting into. So if it's possible, just take a photo of it so you will know what the fund is providing. And just Google it. You will find all the details of, what's open-ended, what's a close-ended, and etc. So there are multiple types of mutual fund that you should know what to get into. Okay, so there are multiple types of mutual fund, offline and online. So all those who are interested in, just go to the online website of the mutual fund. There you can open an account and you can, start buying mutual funds. Okay, the things to remember: investment is not gambling. It is an educated guess, yes, but it is not gambling. You need to put in your efforts to make your money work for you. So you should know, as we discussed, where you're investing, what you're investing in, and who you're dealing with. Always deal with a registered intermediary. Always, be it mutual funds, be it anyone, always deal a registered intermediary only. So important points to remember: whatever document they give you, do not sign just by closing your eyes. Read entire document, and whatever blanks are left in it, to strike it off. Don't leave it blank. Strike it off, and then check the research reports that are there to check the accuracy before you start investing. Keep it small. Once confident, you can move forward. Stay diversified, and the more you trade, the more broker will earn. So be cautious of when you want to buy, what you want to buy. Do not follow market tips. Okay. So with all of these things, I have completed these points to remember. There are a lot of mutual fund schemes in the multiple schemes in the market, like chain marketing, promising additional returns. So just stay out of all of that. That is fraud. Only one thing I would like you all to note here is, on the right hand side, there is a couple of phone numbers. So just note that down in case you have any query regarding the markets, in case you have any complaint to give regarding any broker agency, you want to find out if any agent is a fraud or not, anything. So on the right hand side, there are a couple of phone numbers written: 1800-266-7575 and 1800-227575. Right. So note down these two numbers. It's a it's a toll-free number. You can call up on any working day and get your queries clarified. So with this, I'll end my presentation. Thank you so much for the opportunity given. Happy investing.
Thank you so much, Abhishek sir and Gaurav sir, for your enriching and the informative talk. I would now request Mr. Farhan Khalid, Assistant Professor, Department of Commerce, to conduct question and answer session. Over to you, Farhan, sir.
Thank you, Rachna ma'am. Am I audible?
Yes, sir, you are audible.
Good evening, everyone. Good evening to both the resource person, Kumar Abhishek sir and Gaurav Motwani sir. I'm going to conduct question and answer session now. I have received a good number of questions from the participants. So the questions are to both the speakers. So shall I start? Kumar Abhishek sir and Gaurav sir, shall I take the questions? Abhishek sir. So first question is to Kumar Abhishek sir. How Sebi protect the interest of the investors? And I'm going to add one more question to it. Are online investing apps trustworthy?
Sebi, like whatever a regulator does, the primary objective of that is investor protection. Sebi has three mandates. The first one is protection of the investors. Second one is development of the market, and third one is the regulation in the securities market. So the three mandates, basically, if you look at them, any state, any policies, any rules, any regulations made by SEBI, any activities undertaken by SEBI, these educational initiatives in which SEBI is participating, everything is geared towards protection of investors' interest. So everything SEBI does is for protecting investors. Then the second part of the question was, can you please repeat, sir?
Thank you, sir.
Yeah, second part. Can you please repeat the question?
The second question was, are online investing apps trustworthy?
Yes, sir. So online investing, like which particular app you are referring to? Because see, there can be some apps which are dubious. They are providing you opportunity of investment. I don't know where. So that you have to keep. I mean, you have to maintain a safe distance from them. Those are not advisable. But there are various other apps, like various apps which are providing you an opportunity to invest in mutual funds. There are certain apps. So they are distributors of MP. They have got registration number. There is for mutual funds. There is MP registration number. ARS, that is those are called ARNs. So they have got ARN, and those they are operating in the mutual fund space. So those that are doing good, and you can see that they are particularly regulated. So that is very important. If somebody is assuring you some app that you are investing in some market which is not allowed in India, you're trading in Bitcoin and all. So those kind of things are illegal.
Yes, sir. Thank you, sir. Next question to Gaurav, sir. In which sector should I choose to invest in this time? Which sector will be making profit in coming years, as already the GDP is declining at a fast rate? Yes, Gaurav, sir.
Yes, that's a very good thought. Very good question. As we had discussed, and I told very clearly that we will stay invested for a long amount of time, right? So for the length of time, maybe you can study an industry for a coming few months. That's all right. But when you invested for a long time, for 5 years, 10 years, then predicting is difficult. So what you do is, for people who are getting started with the markets, is the best thing to invest in the entire basket. Now we have a lot of mutual funds starting with, say, Nifty. They follow Nifty. So what is Nifty? Nifty is the basket of 50 securities, and these 50 securities come from all the particular sectors, all sectors, right? So the best part is to stay invested and stay diversified. The moment you get into per sector, you're taking a higher risk, right? So moment you get entered into the market, stay diversified, enter in products like Nifty, which has a basket of 50 securities from all sectors, right? And once you can take that risk, then get into sectoral trading. then you can get into funds. For example, if you take up buy a particular share of Airtel, so you got into telecom sector. Now, if there's any issue with telecom, definitely Airtel will get affected, right? So you cannot put entire money in telecom sector, right? So the risks there with, yes. On the other hand, the returns are far higher. Telecom sector is doing well. Then what will happen? The shares of Airtel will run faster than the other companies, right? But today we know the telecom sector is not that healthy, right? So sectoral trading is very tough. It's a very risky bargain. So staying away from it in the initial years is better. Once you learn and understand the markets better, then you can get into sectoral trading.
Thank you, sir. Thank you for your answer. Next question is to Abhishek, sir. What is the best way to invest? Is it through agent or directly?
So actually, it depends. Like, it depends from person to person. If you have got good degree of knowledge, then probably you can do your own research and make direct investments. I think this is specific to the mutual fund you are asking. In mutual funds, there are schemes in which you can invest through agents or you can make direct investments. These days on television, there are ads also of direct investment. So if you understand the product, mutual fund is not very complex to understand. For an average education, person with average education, we all are educated. We can do our study, we can do our research, and direct investment can be beneficial for us. But if we are not sure, we need certain guidance, certain help, certain direction, then we can discuss with the advisors as well and invest through them. So it varies from person to person, it varies from situation to situation. That's it. I hope that satisfies the question.
Yes, sir. Yes, Abhishek, sir, one question is related to one of your slides in which you were discussing about derivatives. So the question is, what are derivatives equity and equity oriented products? Can you give some examples?
The derivatives are derivatives is the word derivative. When you hear that, it's made from the word derive. So derivative is something which derives value from something else. Suppose we can take a simple example. It's kind of like a farmer. Derivative has different kind of products: forwards, futures, options. Then there are swaps. So these are the products which do not have any value, intrinsic value, but the products which it is based upon, that has intrinsic value. Like suppose I have got some 100 shares of Reliance with me. It has got some value. I want to hold the share for 3 months, but I'm afraid that in 3 months, if price of the Reliance falls, price of share falls, I may lose some investment. I may lose value. So there are some derivative products where I can take opposite position. Like I can sell a put option, or I can enter in a future contract at a higher price. So where if the price falls, then I will be able to sell my shares at a higher price. So the loss which I get by holding my shares for 3 months, that will be set off by the profit which I get in the derivative position. So derivative is highly leveraged kind of product. Like when you suppose you buy a flat by taking loan from bank, it is of 100 rupees. So 20 rupees our contribution, our savings, 80 rupees is the loan from the bank. So that way we can trade in the derivatives. Like with 20 rupees, we can take a position on 100 rupees. If there is a gain of 10%, then we will get 10 rupees on 20 rupees investment. Not we are getting on 100 benefit on the 100 rupees, but our investment is only 20. So even if 10% gain is there, we are getting 50%. But if 10% loss is there, then what is happening? We are losing 50%. So derivative is that is the reason why it is very leveraged, like financial leveraging which we see in the case of home loans. That kind of leveraging is there in the derivatives, and it is because of being highly leveraged, it is highly risky as well. And the other equity related schemes which I was talking about, equity means shares, nothing but shares. So Mutual funds which invest largely in the equity, largely in the shares, those are equity related mutual funds. There are many of them. There are large cap mutual funds, there are small cap mutual funds, there are mid cap mutual funds, there are large and mid cap mutual funds. There are like variety of mutual fund categories. On the slide which was presented, you might have seen. So they have also different level of different degree of risk associated with them. Large cap mutual fund is less risky. Mid cap is more risky. Low cap is small cap is most risky. So they have got degree of riskiness. So that is what I was saying, that these are risky products where we have to understand them, and then only we have to invest in them.
Yes, sir. Thank you, sir. And one question to Gaurav, sir. And the question is, what are the factors we need to consider while deciding the portfolio? Gaurav, sir.
Yeah. What are the factors that you would need to decide on the portfolio?
Yes, yes.
Oh, well, I think it's a very open-ended kind of a question to which I don't see a small concrete answer which I can give. I'll try to cover as much as possible. See, what you need to do is, firstly, you need to understand what is the risk-taking ability. A person with younger age can take a higher risk. A person with close to retirement cannot take that much of an amount of risk, right? So all the products that we had discussed with Abhishek or me, everything has a risk profiling, right? So what you would the best thing to do is, as most of the participants are young in age, so first whatever income you earn, so first you decide how much I'm going to invest, and whatever is remaining, only then that much I'm going to spend. So out of whatever money you have spent, ensure that when you cover a good portfolio for somebody who's a very young would be 75% of your products in 75% of the money in products that are highly risky, about 20% in products that are medium risk, and only 10% that are low risk, right? I think you can go to the internet and search what are high risk, medium risk, and low risk. Basically, your savings account is all low risk, fixed deposits are low risk, your government bonds and gold are medium risk, and the securities market, whatever products are there except debt, is also 70% of your entire portfolio must be in risky products or high risk products, and 20% in medium risk and 10% in low risk.
Thank you, sir. Due to time constraint, we cannot take all the question. So I'm taking the last question, and this is to Abhishek, sir. And the question is, what should be the investment plan for the post-COVID era? Abhishek, sir. Abhishek, sir, you are on mute. Okay, Gaurav, sir, would you like to answer the question?
Yeah, no issues. I'll take
Yes.
that.
Yes.
Okay. In the time of COVID, the first thing that you need to take care of is your health. Health, obviously. So keep that in mind. Secondly, you understand there are a lot of uncertainty in markets. So when there are uncertainty in markets, there are certain products that people invest in. One of them is gold, right? So whether it be the COVID situation, whether it be a non-COVID situation, when we speak of long-term, COVID is a very short-term kind of a thing, right? So in all your investments that you've already started, like in your SIPs, continue them. Don't close any of your SIPs, right? Continue putting that, and the way I had discussed, what the percentage, keep that percentage constant. Maybe if you feel when the markets slightly more riskier, you are not very comfortable at this moment, maybe what you can do is slightly shift the ratio, where instead of putting 70% in risky products, you can probably put it 50% and increase the medium risk and put more amount in things like gold or a bond. So all that is more as per your appetite.
Okay, thank you so much, sir. Thank you so much to Gaurav, sir, and Kumar Abhishek, sir, for answering the questions. And I thank all the participants also for actively participating in the webinar and asking questions. I apologize, due to time constraint, we could not take all the questions. So that's all from my side. Thank you. And over to you, Rachna ma'am.
Thank you so much for answer. I now request Dr. Alok Paran Assistant Professor, Department of Commerce, to propose the vote of thanks. Over to you, Alok sir.
Thank you, ma'am. Ma'am. I, Dr. Alok, Assistant Professor, Department of Commerce, deem it honor to propose vote of St. Xavier's College of Management to help us in say I take the opportunity to put all my gratitude into words. Once a great man heard, feeling thankfulness and not expressing it is like wrapping a present and giving it. So I would like to thank the Almighty for being present. I would like to propose hearty vote of thanks to our guest, Mr. Kumar Abhishek, Sebi, Patna, Mr. Rohit Kumar Singh, Deputy Manager at Head, Patna, and I would like to thank our Rector, Father Joseph Thadmanal, SJ, Principal, Father Dr. T, organizer of this webinar, Vice Principal, Father Dr. Martin Poros, SJ, COE, Father Sebastian Alphonse, SJ, Coordinator, IQSC, Sister Dr. Grace, SCSC, for their presence and guidance. I would like to thank Mr. Ashok Kumar, Coordinator, Department of Commerce and Convener, for conceptualizing the idea of this webinar. I thank our technical team and staff members who have helped us in this webinar. Finally, I would like to thank all participants and all my dear students for showing up their interest in this webinar. Once again, I thank all for your cordial cooperation and thank you